Welcome back, everyone. We are doing something a little bit different. This is our month stock purchase, but we are doing this unscripted to see exactly how well it does for you guys versus our last scripted. So enjoy, and hopefully we do okay.
Well, we're checking, and please comment below on this. We want to know how we're doing with YouTube from now until we did this last year, and even from the very beginning. We're hoping we're getting better on camera. We're hoping we're able to present the information to you in a way that's actually a little bit more entertaining than it was before. And we want to show you the authenticity of the fact that, hey, yeah, we really do what we're knowing. We do what a bit of that.
Yeah.
We really do know what we're doing with finance. The YouTube thing is still new to us. So please let us know how we're doing. We will accept any kind of criticism constructively, and maybe even a few trolls here and there.
Yep. So comment below, let us know which format you like, or if you like both, do that. Say you don't care, as long as the information's there.
Yep, so we have absolutely no idea what we're gonna say. We just know that we're gonna show you our portfolio, that we are up to about $167 a month in our portfolio. This is month 30. So now for month 30, we did buy a few stocks and we went risky this time, which is very unlike me and very unlike Brian.
But we can do that because we, after 30 months, have diversified our portfolio in a way that we're pretty defensive. So now we can delve into some of those riskier stocks and kind of dabble.
Finally. It took us 2.5 years to get to this point. So now we're finally able to start doing some things that some people go, oh, that's interesting. So if we take a look at this and we take a look at the history of the account in itself, diving right in, we can see that, hey, we bought some stocks this month. We'll explain those in just a minute. And then we can also see, I want to show people in particular the dividend checks that we're getting. And if you notice, every few days, we're getting a dividend check now. Now, they're not a lot, but they add up after time. So getting into the positions themselves on the stocks that we have purchased, we need to make sure that in our portfolio that we're rounding out which stocks that we own. And what I mean, not necessarily we're going to buy 10 different companies in one industry sector. We've talked about this before. We're trying to find at least 2 equities, or in other words, 2 businesses in a specific industry segment, if I can say that the right way. So we will not exceed that number. So if we're talking oil companies, we're going to do 2. If we're talking banking sectors, we got to pick 2, maybe even just 1. And we try not to get more than 30 stocks in our portfolio. Why do we do that? It's kind of hard to track more than 30 companies.
Right. And if you've ever done any due diligence on a stock and know how long it takes to do that, try to do that on 30 stocks or 50 stocks or 100 stocks. It becomes way too time consuming.
Yeah, and you might as well just buy an index fund if that's what you're going to be doing.
Right.
So if you look at our portfolio, you can see we're pretty heavily weighted in industrials. We've got a lot of defensive-based stocks, but we added one to our portfolio this month on the list that was considered risky. We're doing a whole video on that one. So if you are interested in why we picked that stock, we'll get into it a little bit here, but we're going to cover that a little bit more in depth in the next video. So in this list, we bought this month Intel, and you can see as a cost basis, let me sort this by cost basis here. So the cost basis for a stock is what you ended up paying for the stock, and then overall what you can see what happened to the base equity value is the gain and loss ratio here that you see on the right hand side. So this month we bought 3 stocks, and Intel was the first stock. We also bought UPS. We just did a video on UPS. You can check that out on our page. And then the last one that we bought, and this is the risky one, is Anelli Capital. Now, if you're new to investing and you're not like this, you have a very small portfolio, let's say you're in month 1 or 2, our recommendation is please check with your financial advisor first, but do not buy risky stocks on month 1.
Right.
Please don't do that. But anyways, we bought Intel stock. The reason why we did that is also based on another video we did with Intel, and we believe that this company is undervalued for what they will be producing in the next few years. So contrary to the channel's name, Dividend Dudes, we bought a stock that does not pay a dividend.
It does pay a dividend. It just doesn't do it right now.
Well, I think it does until September. Like you get one more and then that's it.
Yeah. It will pay a dividend again once it starts to come back. So it's not necessarily a non-dividend paying stock. It's just one that's not doing it for a short amount of time.
And a quick update on Intel is we talked about who they work with in our last video. Intel has signed a contract with Amazon, and they're getting an additional as of like yesterday. So today is September 18th. This happened last night. They finalized a deal with the Pentagon to provide chips to them. So as far as business goes, these guys are doing okay. We touched on that in the last video. This video, we're buying them more.
Yeah, I'll put links to the video up here, little cards, so go ahead and click on those and watch them and come back, or wait till the end and watch them after this.
Yep, that'll explain it a little bit better. As far as the cost basis go, Intel is weighted heavier than any other stock because we see the opportunity with them. Now, what we're going to try to do over the next few months is we're going to level that out with the other stocks. So try not to get above a certain threshold, and we try to balance out the portfolio to make sure that there's equal weighting, because if we're wrong about Intel, at least we have other companies that are still going to be paying us. That way, we're not wrong by they're not cutting us off at the legs here. We can still walk around. So the next few companies on our list, and I'm going to change the sorting so everybody sees the cost basis for all the stocks. I'm going to sort it by gain loss ratio. Now, for the income of the portfolio itself, the gain loss ratio does not include dividend checks.
Right.
So this is just based on the equity value at the time that we purchased it to what it is today. And if you look at this list, you'll notice that quite a few stocks in our portfolio, with the exception of Intel and the few here that we see at the bottom. We got Intel, Devon, Chevron, and Rio Tinto. Rio Tinto has been all over the place.
Yeah, they're very cyclical. They go up, down, all around. Do-si-do.
Do-si-do. So these guys, if you look at the bottom performing ones, the reason why we bought Intel is based on the things that we said in the last video, plus this, plus for the cost basis, we think that over time that'll go up. Now, we had another stock in our portfolio that did that. It was 3M. And if you take a look, you'll notice 3M is up more than 60%. That's when they did their Solventum spinoff. So 3M in particular at the time was also down in our portfolio. You have to go back and check out when we did that recording, because they were red, just like Intel is now. And now 3M is up quite a lot. We're thinking of selling it. Not sure yet. I don't want to pay the taxes on it. So
I think we're going to wait the year and...
Well, we'll have to see. They're still paying a dividend. They look healthy, so that's pretty good. But there's some reason behind why we look at the companies that are performing the worst as investment decisions, particularly because we've said this, 1,000 times, where you buy companies that produce products that people have to have.
Yep. And they have to be healthy. So they may not be making a profit right now, but there's a history of them making a good profit.
Yep. So on that note, we bought one that does not make products that people have to have.
But we've been talking about REITs for months and months now.
I think like 18 months.
Yes. We've been waiting for the economy to turn around, the Fed to do their thing, before we even looked at seriously buying them.
So the next one on our list for month 30 is Anali Capital. Now, these guys pay a massive dividend that is also a risky one. It's an REIT. Now, REITs are taxed a little bit differently, and I'm not going to get into all the minutia of how they work. We'll do that in the Anali Capital video. I can't say that.
That's Anali. So that's coming up in about a week or so. So stay tuned. It'll be our very next video after this.
Yep. So basically, Anali Capital is an REIT that services. God, I cannot talk today. Services mortgage trusts, and they basically do the mortgage-backed securities for basically anybody trying to get a house loan.
Right.
So there's a long story short there. They pay a whopping 12% dividend. Now, Anali Capital, historically, if we pull them up and we look at them here, and you look at all the historical metrics on Anali Capital. Now, this link is from Simply Wall Street. Love this place. Seeking Alpha also has a lot of good information on what's happening with the company. If you look at the earnings and revenue for Anali Capital, historically, these guys have been brutalized. There's some pretty good reasons for that, and it shows them as a negative earnings per share and negative net revenue company. Normally, we would say, company's not making money, you run away from.
Right.
These guys, though, if you look at the gross revenues and you look at their assets or liabilities and everything that surrounds what their business model is, we think there's some bullish signals happening with these guys. Now, you can see this in the earnings and revenue growth forecast further down the page, where Yep, here they are, 2023, they got destroyed, going up to 2024, and then all the way to 2025, everybody expects them to recover. A lot of that has to do with the Fed rate cut. Now, the Fed rate cut did happen today.
Well, if you go back, why are they doing bad? Also has to do with interest rates. If you follow the interest rates, you could follow their earnings and revenue growth pretty tightly.
Yep. So we think as far as all the REITs that are out there, there's AGNC, there's CIO, there's O, there's a whole bunch of them. They all have different kind of takes on what business they work in inside of real estate. Like CIO is more commercial real estate, as an example. If you look at all of those, most all of them have had problems where you buy the stock and the stock just stays flat, but they pay these massive dividends. So there's a risk to this principle that if we're wrong and they continue to bleed money, the stock could go down.
Right.
So if you look at the portfolio itself, we have what I believe to be about 2 or 3 risky stocks in a portfolio that has more than 20 companies in it. So that's Anali Capital, that's RIO, and Devon Energy. I see those as being kind of a high risk play because of what they do. However, we feel that Anali might be on the upswing. In fact, we bought them today and already they're up 1%. I think more than one person was waiting for the Fed to cut rates.
And they did. Today they cut rates by a half point.
Yep.
So that is a clear buy signal for a lot of analysts, and it was for us as well.
Yep. The third one on our list we bought was UPS, which should be in here somewhere. Yes, they're there, UPS. They're right next to an Anali Capital. I'd be surprised I can't find them. So UPS, we just did a video on them. We went through their financials a little bit more in depth, and we had some comments in that video where people were saying, hey, they seem to be cyclical with the economy, and that's true. They're logistics, they're shipping, so if orders and shipments and freight goes down, then UPS is affected by that. However, they're trading, if we just look at the stock itself and we do a purely technical analysis, outside of all the financials that we looked at, and we go back and we look at their chart, and we go all the way back to 2020 before the boom and then the bust of COVID. You can see they're trading around $85 a share, and today they're at about about 130 bucks, $131. So as far as like the average stock market increasing between 6 and 10% per year, they're kind of close to that price target. What Brian and I see happening macroeconomically is the Fed cut rates because the economy is softening, and that's going to show up in UPS's earnings report. You're going to see them have some relatively lower numbers. The market anticipated that with UPS, or they're just coming off the bubble high, and the stock has dropped almost 45%, which brings them right or pretty close to the inline of the 6 to 10% stock growth per year. In addition to that, they pay a pretty hefty dividend.
Mm-hmm.
So if we look down here and we look at their dividend rate, it's about 5% dividend yield.
And they pay consistently, and there's dividend growth.
Yep. Now, I have issues with some of the macroeconomics affecting their finances, but we're not buying the stock because we expect it to explode 60%. We're trying to find a good value in the stock and then hold on to it for a very long time. There's a couple things that you can do with assets that you own in a portfolio. For example, if you like to avoid taxes, you can go into your portfolio and you can take a loan against it, and that's considered basically tax-free. You have to pay the loan back, obviously.
Right.
But there's a lot of different tricks that you can do to help make sure that you are earning money, and UPS is a good one that we think long-term that will help us buy other stocks in the future.
And again, if you want to see more about that, we did a full video on UPS. Go ahead and watch that.
Yep, so that's the portfolio in a nutshell. If we look at our history of the portfolio or the performance, we can put this up here. There, you can see how we're doing in comparison to the Dow Jones Industrial Average, the NASDAQ, S&P 500, and we're tracking pretty closely outside of the dividend checks themselves to the Dow Jones, and that would be to be expected because of the types of stocks that we have.
Right.
I mean, we've got Chevron, ExxonMobil, Johnson & Johnson, Pfizer. I mean, we got all the big ones there, so that's pretty much what you would expect to see. So if you look at the joint tenant, 10.10%, look at the NASDAQ, 17.43%, you say, oh, why didn't you buy just the index fund? Well, that's actually a good point. So then we go to our positions, and we look at our dividend checks. You can see that we're tracking pretty closely to the NASDAQ with the dividend checks themselves. The reason why we do that is more of a defensive paranoia on my part. I like to know that if I have a bill to pay, I have a dividend check there to pay that bill. If I buy an index fund, in order for me to get the money out, I have to sell the stock, and then I have to pay the taxes on that. Now, they're both capital gains, both the dividends and the sale of the original index fund are taxed. But in this case, I don't have to sell any stock to get the dividend checks.
Right.
It's a little bit safer. Now, that doesn't mean you go out and you buy nothing but an alley capital. Because those dividends that are huge like that are very risky. So we try to make sure that when we're buying a company, that it is safe.
Yeah. And keep in mind that an alley capital has to pay out 90% of their taxable income to anybody who buys into them. So all your investors are getting your dividends from that taxable income. With such as their profit and loss, kind of like Zim goes up and down, so does their dividend. So that's 14% now, it could be 7% tomorrow and 10% next month. So you got to keep that in mind and just average it out.
Another thing that to mention on Brian's point was we covered Zim like 3 times. They were originally trading at 80, then they were at like the mid 30s and 20s when we covered them again. We said they would go down to about $8. You can check it. Go back, check it. They went down to $8 and I said, probably be a good time to buy. And as soon as they did, the industry cycled and they're starting to climb back up again. That's great. We don't try to time the market with this. The other reason why, if we look at the gain and loss ratio of our portfolio, this is why. This is a small portfolio by comparison to what we have and what most people who invest on a regular basis have, because we're starting. Again, this is month 30. But most portfolios do not show a gain loss ratio of over 80%.
Right.
So currently we're at 86.82%. And we're getting most of that in the form of dividend checks.
All right, that's the stocks that we purchased, our portfolio update. If you want to do us a favor, take a look at all the stocks on the screen. Give us an idea of what sectors we are missing so that, maybe we could get into that sector. We're pretty much at the limit of how many stocks we want. So if we add 1 or 2 more stocks, that's pretty much going to be it. We're hoping that you found all this information helpful. If you did, we would appreciate it if you like and subscribed. That really helps us out with the YouTube algorithm. And as always, happy investing.